morning from our global headquarters in New York. I'm Manus Craney. You're welcome to Bloomberg Brief. Let's set your agenda. Higher and higher, the S&P 500 hits its 25th record this year, while Nvidia tops $3 trillion in market value. Countdown to the ECB, the central bank is expected to cut rates, with attention shifting to President Lagarde's news conference. We're live to Super Return. Peter Stavros, KKR, co-head of Global Private Equity, joins Danny Berger live in Berlin. A very good morning. Warm welcome to the show. There's a frenetic energy to some of these markets. We are flatlining on stocks. Don't forget, the Nasdaq powered ahead by 2% yesterday. You saw Nvidia break the $3 trillion market valuation. Apple was up for an 8th day in a row. And so there was this frenetic energy in the Mag 7, which now, if you think three of those components, Nvidia, Alphabet, and Microsoft, constitute 50% of the rally that we have had in U.S. equity markets this year. The narrative is that we're getting slightly softer data that emboldens the rate cut narrative, which underpins the equity narrative. By the way, UBS say the AI revolution will deliver more growth. Keep an eye on Lululemon. They were powering ahead. They delivered a beat and a buyback of $1 billion. So to that extent, we're also keeping an eye on that stock, up 9%. But it's got to say, the last time Nvidia was worth more than Apple, that was in 2002. The bond market, yields rallied for 5 days in a row. We're just pausing for thought now in terms of these markets. We've done 20 basis points, down 20 basis points on bonds in the U.S. This is an exceptional bullish repricing. The ISM services might have been emboldening, but the prices dipped and the employment numbers also sub 50 in the ISM services numbers. So bond markets have maybe done a lot of their legwork into the jobs report. It is ECB day. The Bank of Canada cut 108.77. October is now alive, let's say, to the extent of 60%. How hawkish will Lagarde be? Will she want to try and reaffirm we are one and done in this rate-cutting narrative? You know, what is the narrative from the ECB? As I say, they are expected to start that cutting cycle today, ahead of the Federal Reserve. And that's going to be for the first time ever. History in the making. Lizzie Burden is on the ground at the central bank in Frankfurt. Lizzie, good to see you this morning. So history in the making for probably all the wrong reasons that Lagarde doesn't want. She didn't really want to be bounced into this cut ahead of the Fed, but here we are. History and circumstances sometimes force your hand. Good morning.
Good morning, Manus from Frankfurt. Yes, she didn't want to jump before the Fed, but it's what it looks like she's going to do, and it's been well telegraphed. It's fully priced into markets. It's almost unanimously expected by economists at this point. A quarter-point cut from the ECB today. Even the most hawkish members of the Governing Council, the likes of Joachim Nagel and Isabel Schnabel, say that they see the grounds to cut today. But that's raised a bit of an eyebrow, really, given the latest economic data. Inflation sticky, wage growth rapid, and surprisingly robust output as well. So as you say, the focus very much on the path ahead. Now we're going to look to the forecasts, the expectation being that inflation does get back to target next year. But do we see an upward revision for 2026? It would suggest that actually there's a higher bar for cuts going forward. Do we see an upward revision for growth? It'd be good for cyclical stocks. And of course also, Manus, we're going to listen to the press conference with Christine Lagarde later. Is she clear on the cadence for cuts? It seems like it's going to take a real clarity to create sustainable euro-dollar weakness. Yeah, I mean, we're intransigent around this 108, 108.25 level. Lizzie, thank you very much. We look forward to the announcement and, of course, that press conference later in the day. So, as you say, the decision's pretty much baked in. It's about the path ahead that is somewhat murkier. Let's welcome in our guest this morning. It is Ludovic from PIMCO. He joins me now. Ludovic, good to have you with me. I look at the data. Wages are hot, 4.7% in the first quarter. The CPI above trend, and the services inflation is also hot, and the 3-month average is far from where they really want to be. My question to you is this: should they really be cutting?
Hi, Manus. First, I'm with Allianz, even though we own PIMCO.
My apologies.
On behalf of Allianz. I think, the reason for cutting is threefold. The first is recession risks are higher than inflationary risks. yes, services inflation is sticky, and there, yes, wage data is a bit picking up, but there is no wage price loop. And at the same time, we really see the sluggishness of growth once we have a bit less fiscal support. As you know, it's the big story of consolidation. Second, I think it's amazing that the ECB graduates. I mean, it's not a teenage central bank anymore. They can take their independence from the Fed. I think that's going to be a massive signal, and I'm quite happy about this. I was a big skeptic on that point because I think the financial cycle is really US focused. We see that everywhere in the correlations among assets. Mm-hmm. So if they do that today, that also shows a real political independence, because remember, we have elections later this week, and the others may not have done that. And the third reason is very clear. I do think that the path ahead is very gradual. So even if they cut now, we expect still 2 cuts this year. So it's going to be cut, pause, cut, and the terminal rate's only of 2.5 next year. So it's still quite, I would say, still a very conservative monetary policy, and this is really something that is in tune with, I would say, the determinants of growth in the Eurozone today.
That conservatism that you say, and I like the analogy in terms of a teenager, political independence, a spirited mind of their own, detaching from that symbiotic relationship with the Fed. I don't think it's broken, but I think it's a lovely way to portray it. But you talk about the propulsion for rate cuts being much more aggressive in 2025, which then makes me wonder, well, what is so malevolent in 2025, Ludovic?
Well, then the Fed will have started to cut. That is, if Trump doesn't come back and makes a big reflation, from protectionism and discrediting the Fed, right? So that is a very central scenario. But yes, I think the last stronghold, the last bastion, is indeed to make sure that the ECB is not too ahead of the Fed. Mm-hmm. So that's where the graduation of the teenage years is a bit so important. I think in 2025, by then the Fed will have a bit more forward visibility on its own loosening cycle, and then the ECB can get to a rate cut cycle or pace of 25 basis points almost at each meeting. That's how they get to the 2.5. I think what markets are pricing in right now is a bit cuckoo, if you pardon me. Like the more than 4% terminal rate in the US is unheard of with 3% growth, and something in the tune of 3% terminal rate, in the Eurozone is also unheard of. So I think they're going to come to their senses, and we do believe that 2.5 is an okay terminal rate for the Eurozone, and that means, a much more cadenced rating cut cycle in 2025 indeed.
What a wonderful way to describe the mispricing in markets, cuckoo. So if we are mispricing the perception of the terminal rate, then what else are we mispricing in the rates market?
That's a good question. I'm often a bit on the edge when it comes to the idea, and you've seen what happens right now. The fiscal policy is very central to everything that is going to be priced in the coming months. So I'm a bit concerned about how markets welcome the fiscal news, especially the fiscal profligacy news. As you know, we are going into a moment where we're going to have this debt sustainability analysis coming from the Commission. We're going to have the excessive deficit procedure list. So I'm a bit worried that some people get antsy or get a bit concerned about the Italian fiscal trajectory, the French fiscal trajectory, and so forth. So that's concern for mispricing on the rate market today. Yeah.
So how sticky is, the debate that I was having with, not debate, Lizzie was sort of proffering the idea about the sticky inflation in Europe relative to the stickiness of inflation in the United States of America. And a lot of this stickiness comes down to the intransigence of energy as well in the component parts, as well as housing. So how sticky, if I look at the break-evens, they are beginning to roll down both in the US and in Europe, and we can talk about the seasonality of break-evens. But the trajectory of break-evens is coming down. Does that embolden the narrative that inflation is not as sticky as we're writing about?
That Lizzie was right. A lot of people are going to look at staff projections today, because in every model that I see, including ours, we see this very sticky services inflation part, which is historically not happening. So we see in every model now, if you look at monthly or quarterly modeling of inflation, you have 1.5, even sometimes 2 percentage point of services inflation, and all the rest is at 0, even contributing negatively. That doesn't exist, right? So there is a bit this idea that there will be no gravity for services inflation. I tend to disagree with that. Of course, the good news is second part of the year with a bit less inflation and still wage growth, you're going to have positive real income effect. But keeping this, 1.6, 1.7 percentage point of services inflation all through the horizon of forecast is not possible. So I think the break-evens are actually coming to the realization that, of course, services inflation is going to start to, the pricing power of this services company is going to start to wane down as, of course, they cannot continue to have such a good ride as they've had over the past 2 years when it comes to putting a full transmission of their price and the cost to the customers. Yeah.
Ludo, thank you so much for being with us. I'll get the company name correct this time. Freudian slip with the PIMCO. That is Ludovic Subran of Allianz. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. Trafigura posting the smallest first-half profit since 2020. That's down 73% from a year earlier. The results signal how the commodity giant is adjusting to calmer conditions across its key energy and metals markets. Trafigura and its rivals have been warning for some time that they don't expect the blowout profit numbers of the past few years to continue. Blackstone is buying France's SEV Group from Triton Partners. The deal values SEV at more than $653 million. That follows a string of similar transactions for Blackstone as it seeks to grow its business investing in energy transition. The billionaire eco-founder of Patron Tequila is among the group of investors who've made a bid to take over Paramount. The group is said to have made an offer several weeks ago, and that's more than the bid from the producer, David Ellison. Coming up, a new member of the $3 trillion club. NVIDIA tops a milestone, the market cap with only Microsoft in its way. We discuss the impact right here. And we have Ella Hoxha, head of fixed income over at Newton Investment Management. She joins us to discuss the divergence between the US and Eurozone economies. Context matters on Bloomberg.
We're saying to ourselves, wait a minute. If NVIDIA is going to keep running like this, the only reason it should deserve to do that is if it's going to benefit a lot of other companies. And we began to look at what those other companies might be.
ARK Investments, Kathy with us, speaking to Bloomberg's David Ingles at the Greenwich Economic Forum in Hong Kong. Well, NVIDIA isn't showing any signs of slowing down, is it? Topping out the $3 trillion mark in market value, leaving only Microsoft in its path to becoming the world's largest company. Tom McKenzie joins me now. Tom, good to see you. So what are the odds that NVIDIA will make and take Microsoft's crown? I mean, it just seems the propulsion in this story, it's sort of very, very furious, isn't it?
The march to $3 trillion just seemed inevitable for NVIDIA. And this week, a couple of catalysts coming to the fore. One, of course, you had Jensen Huang over in Taiwan, making again the pitch that this is a company that is not just going to be fueling the data centers of AI, but it's going to be in every single laptop in terms of AI laptops, in companies at the commercial level, at the business level, in terms of pharmaceuticals, in terms of cars, and beyond. The sovereign play as well, countries building out their own AI capabilities. And he was just stressing how much demand is there and their centrality within that AI revolution. And then, of course, you come yields coming down, expectations that maybe rates drop, and that is broadly, of course, helping as well the broader tech sector. But yes, look, the superlatives come thick and fast for this company, above $3 trillion, overtaking Apple. Jensen Huang's own wealth, increasing $5 billion US, $5 billion US in a single day. They've added $1.8 trillion in market cap year to date. Gains for the stock, of course, around 150%. Does it overtake Microsoft? For now, the grind upside for NVIDIA keeps going. It's still got a bit of a gap with Microsoft. And of course, Microsoft has its own AI play around OpenAI. So we shouldn't jump to conclusions. But the trajectory seems to be at least potentially on that path.
Yeah, I just wonder what it is that sort of breaks the dam around NVIDIA. Is it one of those people that they deliver the chips to actually coming through with something of a comparable nature? It's that moat. It's the concept of the moat. Listen, we talk about a $3 trillion valuation for NVIDIA, and then we talk about it. It's important to put context around this. ASML is rallying, and they've topped out LVMH, the second largest company in Europe. Again, a propulsion within the chip industry, but it's pretty amazing when you you look at 3 trillion versus 410 billion. It just shows you the sort of the European-US tech gap.
Yeah, the dwarf, really, that you see when you put NVIDIA alongside ASML, because NVIDIA can make that in a couple of days in terms of market gains. But look, for the European story, of course, it's significant. You have ASML, the maker of these extreme ultraviolet lithography machines, these very, very complicated pieces of kit without which you cannot be crunching out the most sophisticated semiconductors on the planet. And of course, they have their own moat around this. They have a monopoly on the most sophisticated machines. They have that market cap. They're beaten, of course. They come above LVMH. We'll see if that's sustained. A couple of lines came through for ASML. We had confirmation they will be delivering one of the most high-end extreme ultraviolet lithography machines to TSMC, of course, the maker and the owner of those foundries over in Taiwan and elsewhere. They've already delivered one to Intel. Bloomberg Intelligence says that could add around 700 million euros to the bottom line for ASML this year, and they expect, the company's already flagged that in the second half of 2025 they see upside in terms of demand for these pieces of kit. So yes, it's a notable mark in the sand, certainly for ASML, but you're right to point out that that gap continues.
Listen, we've seen a number of challenges to deals and technology deals, and certainly challenges coming from regulators. Talk me through what we know about the Microsoft story at the moment in terms of investigations.
This is the Federal Trade Commission now investigating Microsoft's deal. It was an interesting, really intriguing deal. You had this startup, a lot of hype around it, a lot of expectation, a lot of aspiration around inflection. In March, Microsoft did a deal that involved licensing their AI product from Inflection for about $650 million US, but also taking and incorporating most of the staff, including Mustafa Selman, who was the CEO and a former, by the way, co-founder of Google DeepMind. That happened in March. There were some voices at the time who said, look, this may invite scrutiny, regulatory scrutiny. That is now what's happening. The FTC saying they want to know the nature of this deal, what led up to that deal. Interesting at the time when the FTC is also probing Microsoft's connections to OpenAI, the Department of Justice as well, according to the New York Times, looking at NVIDIA and whether NVIDIA has broken antitrust laws. These companies should be expected to fight these investigations. But nonetheless, it does remind us that there is that scrutiny now from the administration.
My favourite line in the NVIDIA story this morning is Gensanity. There you go. Gensanity. Everybody's in. Tom, thank you very much for wrapping up the tech stories as they flow across your Bloomberg terminal this morning. Coming up, we take a look at what else is making headlines around the world right here on Bloomberg. Context matters. Good morning. This is Bloomberg Brief. I'm Manus Cranny in New York. Let's stick with the AI theme. ARK Invest CEO Cathie Wood spoke to Bloomberg's David Ingles on where she believes technology will take us.
The biggest AI project on Earth is autonomous driving. And of course, Tesla is in the pole position for that. We were struck that the Chinese government invited Tesla to work with Baidu's Apollo on its autonomous effort. Now, obviously, Baidu has been working on this for quite some time, but clearly it isn't where the Chinese government wants it to be, and so it's invited Tesla in. So Tesla is our largest position, and we think autonomous driving, that entire ecosystem globally, including China, is going to scale from a revenue point of view from really essentially nothing now to $7 to $8 trillion. And when you talk about revenues, just to put that in perspective, global GDP is about $130 trillion. So this is going to move the needle in the next 5 to 10 years. And half of that revenue, 3 to 4 trillion, is going to go to the taxing platforms like Tesla. Other names that importantly are harnessing AI and are not well recognized are in the what we call multi-omic space. So this is the convergence between multi-omic sequencing, so DNA, RNA, protein, methylation, and so forth sequencing, and artificial intelligence. So in drug discovery, recursion pharmaceuticals is a very big one. In synthetic biology, twist bioscience is a big one. And then, of course, we have Palantir in the software space, which is helping companies set up to capitalize on AI. But we're saying to ourselves, wait a minute, if NVIDIA is going to keep running like this, the only reason it should deserve to do that is if it's going to benefit a lot of other companies. And we began to look at what those other companies might be.
Cathy Wood on her opinion about Tesla and obviously their stakes therein. Speaking to David Ingles, quick check on the oil market. Down for 4 days in a row. We're just trying to settle our nerves at the moment. Aramco slashing its prices to Asia for the first time since February. And Prince Abdullah's bin Salman, the Saudi oil minister, says, give it a day or two, reality will settle in. So you got Brent and crude trying to hold the line. They're still down 3.25% this week. From our global headquarters in New York, I'm Manus Cranny. Let's set your agenda. Higher and higher, the S&P 500 hits its 25th record this year. NVIDIA tops $3 trillion in market cap. Countdown to the ECB, the central bank is expected to cut interest rates, with attention shifting to President Lagarde's news conference. And we're live to Super Return. Peter Stavros, KKR co-head of global private equity, sits down with Bloomberg. Good morning. It was a frenetic, furious rally that saw the Nasdaq punch up 2% yesterday. The Mag 7 really was quite furiously lit up. NVIDIA, Alphabet and Microsoft now constitute 50% of the rally in U.S. equities this year. The Nasdaq, as I say, was up 2% almost yesterday. We're up 0.1% this morning. The victorious in that story, of course, NVIDIA, topping out $3 trillion in terms of market cap. Can that endure? It trounces Apple for the first time since 2002, and Apple is up for the 8th day in a row. There's NVIDIA up 1.125%. Also keep an eye on Lululemon, up 13%. There was a nice beat in the numbers and a buyback of $1 billion. The stock is up 9% and change. Of course, the confluence of the drop in yields also emboldens the growth narrative within the equity story. We're down 20 bips in terms of the week this week. This is a fundamental bullish repricing in the bond market. Even though you had a strong services, ISM, prices did dip and employment was sub 50, and that again emboldened the narrative. Earlier rate cuts in more size. To the euro dollar, it's a genuflection really to the ECB today. They'll cut 25 basis points. That is the fundamental assumption. The question is, how hawkish will Lagarde be, and will she intimate it is one and done? And of course, going into 2025, we just caught up with Allianz. They're expecting 4 cuts in 2025. Well, we're counting down to the ECB decision. It's less than 3 hours away. The central bank is, as I say, expected to pull the trigger on the rate-cutting cycle before the Federal Reserve for the first time ever. Lizzie Burden is at the central bank in Frankfurt. She joins us now. So, Lizzie, when we look at the data, inflation, some would say, is stickier in Europe. Wages are hot. They're hot in Germany. They're hot across Europe. Should they be cutting at all?
Yeah, there is particular concern from the officials representing Northern Europe, Manus. I've been watching the Governing Council members trickle out of the meeting. It looks to me like they've cast historic votes this morning. But this June cut, well telegraphed, fully priced and almost unanimously predicted by economists. Therefore, the focus is on the path ahead. How many cuts do we see beyond June? And as you say, the inflation data has been stickier. The wage growth numbers actually more rapid in recent times, so casting doubt over how many cuts we will see in the future. Traders paring their bets to just 2 now, even though economists mostly see 3. Allianz, as you were speaking to, seeing 4 this year. And actually now, therefore, parallels being drawn between the euro area situation and the American situation. Because yes, the origins of the inflation crisis very different. In the US, of course, it's about that massive fiscal stimulus. In the euro area, it's more about the energy crisis after Russia's invasion of Ukraine. But now they do seem to share a problem, which is that the policy easing now has the risk of being seen as policy errors down the line.
Yeah, well, just take yourself back to 2008. They, of course, nobody could foresee Lehman's. And 2011, they were fundamental policy mistakes at the ECB. Lizzie, thank you very much, Lizzie Burton. We look forward to your coverage through the day. My guest this morning is Ella Hoxha. She is the head of fixed income at Newton Investment Management. Ella, good morning. Good to see you. We had Allianz a little bit earlier on saying this is a demonstration of the ECB going first. It's a sense of maturity and independence from the Federal Reserve. I would counter all of that saying, looking at the hot data, should they really be cutting at all?
The credit indicators suggest that policy is already tight. So monetary policy is already tight in Europe. So certainly from that perspective, you can argue yes. And of course, in terms of the inflationary backdrop, things are much better than they would have been, say, up to last year. And so, yes, there is actually quite a bit that warrants this rate cut. And of course, we are sort of way above the neutral rate level for Europe. So I think, yes, absolutely fair.
OK, so for you, credit is tight. Therefore, the optionality that Lagarde wants, many are saying that she wants to try and close off July being a live meeting and really give herself and the ECB the opportunity to extend and to look at more data. Do you think that's wise, or would it be more instructive to go back to back and then done?
Well, our understanding is that there is a little bit of contention within the Governing Council, so you can see more clearly the first two cuts, but what happens beyond that is a little less clear. And so with that in line, they need to buy some insurance and therefore put data on the table. So I think perhaps the nuance today from Lagarde might be a little bit more balanced, as in, OK, so we're cutting, we have enough evidence to do so, but further cuts will be warranted on the back of data.
What do you make of the argument that the longer the Fed remains on hold or higher for longer, as the current situation is, the more it inflicts credit tightness, it permeates from the US into Europe? Do you think that that's a valid argument?
I would say so, and I would say so because when you look at credit card delinquencies, auto loans, when you look at sort of business bankruptcies, but also demand from credit, despite the very tight spread levels that we witness in credit markets, demand for credit has not been resurging. And so therefore, that tells you that there is enough tightness from a monetary perspective in the US. And you know, due to the global nature of financial markets, you do feature some of that into Europe.
So we've been rallying globally in bonds for 5 days in a row. In the US, we're down 20 basis points. Likewise, in the rest of the world, there has been this quite significant bullish repricing. Any sense of exhaustion in that, or will the actual delivery of 25 basis points embolden the narrative for duration in Europe?
Well, we had a cut from Canada yesterday as well, so we'll get this from the ECB today. And so there is certainly an argument to be made. I would say you have to sort of divide the very short term, the next couple of months, perhaps we could be more of a sideways trade. But I think further down the line, over the next few quarters, we actually do like duration. We've been increasing interest rate sensitivity. There's room for us to do more. And that's on the back of the jobs numbers out of the US and the sense that the global growth picture is a little softer than we are sort of giving it on the narrative in markets. So we're certainly taking that view that we might be looking at a softer backdrop over the course of the next 6 months. And therefore, that warrants potentially lower rates, and therefore duration or interest rate sensitivity should be going up here.
And this is very, very clearly laid out by you. You talk about I quite like the way you sort of say we've been lulled into a false sense of security. So this is what you say. Investors have been lulled into a false sense of security over resilience of the US economy. And the main topic is whether the US is slowly gliding to a recession. And the jobs trend says so. So what kind of land? I mean, if you look at the data this week, Ella, you know, you get a bit more nervous, and you can understand why Treasuries rally 20 basis points, because even within the services data being so strong on the headline, the jobs number within that component and indeed the wages aspect within that component both emboldened the need for cuts. So, you know, what kind of landing are you going for? And then the corollary to that is how low do we go in yield? Are we at the beginning of a next big push lower in yields?
Yes, I mean, I think, look, the secular backdrop for yields is a bearish one. Let's just put that on the table. So 2 years out and longer, I think we're looking at a bearish market for bonds. But yes, over the course of the next 2 to 3 quarters, I think the case for lower yields is very strong. And actually, the soft landing narrative that we allude to is much better priced in markets. And what is not priced is this idea that the economy might be slowing down. We're not talking about a drastic sort of decoupling of the economy, but sufficiently softer than what the consensus expectation is, I think is quite possible to us. And I'd probably give that a greater than 50% probability as things stand.
Okay. Ella, thank you so much. As you say, for the next 3 quarters, yeah, you maybe want to be longer duration, and then we can talk about the fiscal adjustments that maybe come to pass in the United States of America 2025. Ella, always great to get your opinion. Ella Hoxha there of Newton Investment Management. I want to bring you some live pictures. This is the President of the United States. He, along with his wife, Jill Biden, on the Normandy in Europe, greeting veterans at the Normandy American Cemetery. Now, this is in France, and he will be delivering the remarks at the D-Day anniversary commemoration ceremony very, very soon.
There are people that depended on a low-rate environment to get exits. And I don't think that low-rate environment's coming back anytime soon. I think rates will probably come down from here, but we are in this environment for some time. I think that's a good thing.
The valuation environment has fundamentally changed. And as a result, private equity sponsors are just going to have to hold companies longer, have to grow into those capital structures, are going to need to take on equity to get some refinancings done. And all that means, it's just math, that returns are going to be lower over the next few years.
I think there is a backlog of transactions that were supposed to happen in the last 12 to 18 months that have been delayed, but they are coming, and we're seeing that in the pipeline today.
You're seeing deal activity come back, certainly over a lower base from last year. And our view is that that's going to pick up over the course of this year into next year, simply because limited partners in private equity want to see their capital back.
In general, just the need for this type of capital is insatiable.
Clarion call for deals. Some of the guests that we caught up with at Super Return Conference, where we return to. My co-host Danny Berger is on the ground in Berlin at the Super Return Conference. Danny, great work over the past couple of days. What have you got for us next? Good morning.
Good morning, Manus. Wonderful to see you, even though it's from afar this morning. This morning, I'm so pleased to say that we have another excellent conversation. It is Pete Stavros. He is the co-head of global equity at KKR. Pete, thank you so much for joining this morning.
Thanks for having me.
So we were just on a panel together, just doing your fireside chat, and there we talked about this idea of over-deployment, that in 2019, $1.5 trillion was the net asset value of assets within private equity. Now that figure is $2.25 trillion, a huge amount of growth. What's going to be the consequence of that growth?
Well, yeah, our industry unfortunately over-deployed in 2021 and 2022, and at a time when rates were lower. The 10-year in the U.S. was about 1.5. Now it's 4.5, and multiples have come down as a result. In the private markets, we're down about 3 turns of multiple, and that's going to mean those vintages are challenged. And what we're hearing from LPs is, because we over-deployed in that period of time when values were higher and liquidity is going to be lower, what that means is LPs have spent all this money and they're not going to get money back anytime soon. So it's creating a more difficult fundraising environment.
So for companies that really suffered of this problem, that did a lot of over-deployment, are we talking about consolidation in the industry? Will some funds struggle to survive because of the over-deployment? The challenge that is to valuations of exiting and to fundraising now?
I'm not prepared to predict that, but I think those vintages and those funds are going to be tougher. To the extent your fund is overexposed to those periods of time when values were higher and people overspent, then that's going to be a tougher fund.
Do you see consolidation in general in this industry if we are going into a period of toughness?
I don't think so. There have been certainly stake sales of private equity firms, but I don't foresee some big wave of consolidation where bigger firms are buying up a bunch of smaller private equity firms.
Right. We also talked about this idea of less IPOs, less exits happening in the world. To what degree is this temporary or a structural shift that just the world doesn't want to be public anymore?
Well, I think part of it is structural. If you look at it, the number of public companies in the U.S. has gone from 8,000 to about 4,500. So companies are staying private longer. and are not accessing the IPO markets as much as they once did. And so you're seeing this institutionalization of private markets. And that has certainly benefited private equity. And I think it's also benefited the performance of private markets relative to the public markets. If you look at the Russell 2000 and you compare that relative to the buyout universe in terms of growth and margins and return on capital, the private markets today have a stronger portfolio. And then on top of that, private market investors can pick their assets, choose their management teams, pick their entry and exit points, customize their capital structures, design really sophisticated incentive plans, and drive value creation. So I think for both of those reasons, the public markets, I think, are set to continue to, the private markets are set to continue to outperform.
I wonder what to degree this is a healthy trend. Because if you think of everyday retail investors, their access into the market, it's through an ETF. It's maybe they log onto their Schwab account and choose individual funds. What does it mean for the world if they have less of an option, if more of the companies that they can access are just such a small percentage of the universe?
Yeah, well, I think we're going to have to find ways for retail investors to participate in the private markets as this shift, continues and as the private markets continue to gain share. And today, the way it works is, for the most part, if you have a pension fund, your pension fund might get good access to alternatives. But short of that, historically, you've been out of luck. And there's a number of managers, including us, who are working on the so-called democratization of alternatives.
So in this world of maybe more muted returns, I know one way that you're trying to squeeze out performance is by looking at the corporate culture. I know you're giving equity to some of your companies, some of the workers in those companies. You're looking at CEO empathy as a measure. Pete, this is very different. You're almost Pete the psychologist just as much as you are Pete the investor. What was the change in mindset for you? What prompted you to start looking at this as a factor of company attractiveness?
Oh, gosh. Well, part of it is how I grew up. My dad was a construction worker, was a member of a union, and he hated his company. And there was, we lived through a lot of strikes as a family growing up, and that left a mark for sure. And you could also see not only it being bad for my dad and his colleagues, but it was bad for the company. I mean, at every turn, if my dad had a chance, he stuck it to the company, believe me. And that is corporate America. 70% of Americans are disengaged on the job. An average company has between 15 and 20% of its employees that Gallup defines as actively disengaged, meaning they are literally throwing wrenches in the machines trying to hurt their employer. So there's a huge opportunity here to help human beings be more engaged at work, happier on the job, and to help investors drive better cultures. In the United States, the quit rate peaked recently at 40%. So 4 in 10 Americans quitting their jobs. What a waste. What a waste of human potential for people to be just bouncing around from job to job. Right. And what a waste for productivity and corporate performance.
And I guess, we can say, look, that sounds really great to be giving folks options, equity options in the company, to be giving them equity. But we're talking about often blue-collar workers, maybe on a factory floor, maybe like your dad. These are complicated financial products for them. And presumably some of them would rather maybe just get a paycheck, a higher paycheck, so they can go on a vacation. How do you solve for that financial literacy issue?
Well, first, on your last point, this cannot be a trade for wages. That is a core principle of ours. You can't give stock and take away wage increases or a 401k match. It's got to be incremental. Now, to your point, this is hard to do. It sounds so easy, like you just give workers stock and they're happy. That's not what happens. They need to be kept informed. If you're a worker and you get given stock, guess what? Your expectations of the company just went up. You tell me I'm an owner. I want to know, what's the business plan? Where are we headed? How can I help? How am I doing? Most people go home at the end of their day job and they talk to their partner, and their partner's like, how was your day? How'd you do? No idea. I get no feedback. I don't know how we did. So sharing information, teaching about the business, driving employee engagement, teaching financial literacy, that hard work has to go together with employee ownership. Otherwise, it's not going to work. The magic is getting employees to feel respected, trusted, valued, like they're more than just dispensable widgets. And then you've got a chance to really to rise up and change the culture. Yeah. And to your point, it's the leadership. So with great leadership, anything is possible. You can move mountains. Right. And with poor leadership, it's never going to happen. which gets to your empathy point.
Right. But Pete, it sounds really wonderful, but you know that and I'm sure you've gotten this, I'm sure there are people who've listened to this and said, Pete Stavros, it sounds great, but it's nothing but fluff. It is a PR stunt. In fact, I could pull up an example of a KKR company that didn't like being bought. Pimlico Plumbers, recently interviewed by Bloomberg, who look at these sorts of things and say, this is just a PR stunt. What do you say to those skeptics? What do you say to them to say, this is not just an activity, an image of KKR?
Well, I would say there's too much substance. We used to get that. Right. We've been at this 15 years. I would say in the beginning, people would say, oh, you're giving stock. It's a PR stunt. There's so much substance to it. So when we show workers' lives being changed, and not just financially, but the way they feel about themselves and their role in the company, and we have data to show, engagement scores and quit rates, engagement scores going up and quit rates going down, yeah. I think that's kind of over there's no substance. What we do here now is, well, you're doing it, there's substance, but the reason you're doing it is because of PR. And it's like, I can only tell you inside of the firm, there is no discussion about if we do this, people will think better of us. We're doing this because it's the right thing to do.
And this goes bigger than KKR. I mean, you have a whole charity about this, getting folks to sign up.
And I should say, in KKR, this is what Henry and George did from day one. Everyone participates at our firm, whether you're a new executive assistant or you're the most senior investor. Everyone has stock in our firm. Everyone participates. So that's the example that they set. And yes, at Ownership Works, this is about much more than just what we're doing at KKR. We've now got a coalition of, upwards of 100 organizations working together on this. So think of not just investment firms and Wall Street banks, but we've got pension funds. We have union leaders working with us. We've got nonprofit foundations, some of whom fund the most critical organizations of private equity out there. We're all working together to try and make this effective.
Pete, unfortunately, we're out of time. We're going to have to leave it on that note, but what a great note to leave it on. Pete Stavros, thank you so much. Again, that was Pete Stavros of KKR. Coming up next, Manus is going to get you covered on all the news you need to know, all the events to set up your day. This is Bloomberg.
Here's a look at the rest of your day. Counting down to the ECB decision, 8:15 a.m. Eastern Time, followed by President Lagarde's news conference. What tone will she set? Jobless claims at 8:30 a.m. Obviously, the last piece that we get ahead of the jobs report tomorrow. Treasury Secretary Yellen speaks on financial stability and AI at 1:30 p.m. Our show starts with NVIDIA and we close with NVIDIA. Breaking the $3 trillion valuation, we ramped by over 5% yesterday to take us above the $3 trillion plimsoll line. Novavax expecting to be ready for COVID vaccine delivery in the US in September, pending authorization. And Lululemon, get out there and jog. Get your smarts on, extending their gains, raising the full year profit outlook. You're buying your shorts and they're doing a buyback for $1 billion. From New York, good morning.